Take a look at this scene. In the 1980s, Sears was a titan of American retail. They moved massive volumes of consumer goods, dominating shopping malls and absorbing billions in everyday spending. But the 2010s brought a slow, agonizing decline. Investors watched the company stagger under massive debt. In 2007, Sears shares traded at a peak of around $115. Over the next decade, that number slowly bled out, eventually dropping below a single dollar. The breaking point arrived on October 15, 2018. Sears had a $134 million loan due that exact day, and they did not have the cash to pay it. They filed for bankruptcy. A year later came the final blow. It was announced that the company would be completely shut down and its remaining assets liquidated to pay off creditors. The shareholders were told they would receive absolutely nothing. According to strict financial logic, when a company is dead, its assets stripped, and its equity canceled, the value of a single share must instantly evaporate to zero. But that didn't happen. Instead of vanishing, millions of these dead shares continued to change hands for years. The price kept hovering between 20 and 40 cents, which raises a bizarre question. Who is buying millions of shares in a guaranteed failure, and why? The buyers of this zombie stock didn't actually care about Sears or its underlying value. They were playing a game of hot potato based entirely on human psychology. Because the shares were trading for pennies, speculators bought them on the tiny chance of a miraculous bounce back, or simply to exploit the daily price fluctuations driven by fear and greed. This behavior isn't an outlier. It's a concentrated look at the mechanics of the entire market. Trading only happens because participants look at the same asset through radically different time horizons. At the absolute longest end of the spectrum, you have the promoters. These are the founders, owning families, or even governments who hold massive chunks of a company. In some markets, they might own 40 to 50% of all available shares. They almost never sell. For them, holding the stock isn't about scoring a quick profit. It's about maintaining strict corporate control. Right alongside them are sovereign wealth funds and pension funds. Think of national entities like Norway's Wealth Fund or massive retirement systems. They are the market's heavy anchors. They pour money blindly into index funds every month and hold those assets for decades, completely ignoring short-term economic chaos or the daily news cycle. But those decade-long holders only make up one side of the equation. To keep shares moving, you need a frantic, invisible ecosystem of speed-based participants. Meet the arbitrage traders. These participants couldn't care less about what a company actually does. They are entirely focused on spotting tiny inefficiencies in the system itself. If a stock is listed on 2 different exchanges simultaneously, an arbitrage trader will monitor both. If the price differs by even a fraction of a cent, they will buy shares on the cheaper exchange and instantly sell them on the more expensive one, pocketing the microscopic difference. High-frequency traders, or HFTs, move the game from the trading floor to the data center. These are algorithmic systems housed in specialized infrastructure that react in fractions of a second. HFTs use complex code to execute massive volumes of trades in a matter of milliseconds. They are moving in and out of positions so fast that their actions are entirely divorced from a company's real-world performance. It's all about raw speed. Zoom in a little closer, and you find the intraday retail trader. Operating from a home desk, they hold stocks for anywhere from a few minutes to a few hours, trying to capture daily momentum shifts before the market closes. Zoom out slightly, and you find the positional retail investor. They operate similarly, but have a bit more patience, holding their bets for a few days or weeks to ride out a specific trend. These millisecond algorithms, daily retail bets, arbitrageurs, and pension funds all overlap in the same space. That dense, chaotic mix is exactly why when you click Buy on your phone, there is always someone instantly available to take the other side of your trade. When you submit an order on the open market, you have absolutely no idea who is on the other side. Their identity, their strategy, and their motives are completely hidden from you. There are rare exceptions, like a block deal. This is a massive transaction where 2 large entities agree behind closed doors to trade millions of shares at a fixed price. Because the price is prearranged and executed in a specific window, it doesn't immediately affect the open market. That's very different from a bulk deal. In a bulk deal, an entity dumps more than 0.5% of a company's entire stock straight onto the open market during trading hours. The sudden shock of supply or demand directly disrupts the live price. But for the everyday open market trade, the opposing motivations are a mystery. The person selling to you might know terrible news is coming, or they might just need the cash to put a down payment on a house. You simply don't know. This creates a psychological paradox. Two investors look at the exact same data, evaluate the exact same asset at the exact same second, yet both conclude they are outsmarting the other. The buyer thinks they got a steal. The seller thinks they made a great exit. We often treat the stock market as a calculator that outputs an objective, agreed-upon value for a company, but it isn't. The market is an engine, and it is powered entirely by the constant friction of opposing philosophies, differing goals, and entirely different timelines.